everyone. In today's session, we are going to discuss about the different theorems that are there with the bonds. Now, to classify the theorems, there are broad classifications that can happen of the theorems. Is that there are four theorems that we have. In today's class, we are going to discuss the first two theorems that we have. And let us start off with the first theorem that we have. The first theorem that we have in the bond says that the bond prices and yield moves inversely. I write it again, bond price and yield moves inversely. Now what does this mean? So we know what is the bond price or the value of the bond, right? So how we are going to calculate the bond price? We calculate the present value over there. And so what does the theorem that says to us? The bond price or the bond value, that is the present values of the bond, with that the yield has an inverse or a reverse relationship. That means if I increase the yield, say for a given scenario, so if I write my yield and my bond price, so if I increase my yield, the effect that it will have on the bond price will be opposite or an inverse relationship. Means if I increase one, the other one has to decrease. Similarly, if I decrease my yield, my bond price has to increase over there. Now let us take a problem to understand how this inverse relationship actually happens. Now, say for example, if I assume that the bond price or the bond value is somewhere around, the bond face value is somewhere around, say rupees 100, and my duration that I have for this bond is for 2 years. And if I assume that the interest that we are going to generate, or the discounting factor for that matter, if the discounting factor is say 10%, so how we are going to calculate the bond price over here? We are going to calculate the bond price over here as 100, that is the face value divided by 1 plus yield or 1 plus discounting factor to the power of n over here. So how we are going to calculate the bond price for this? We know the face value was rupees 100 divided by 1 plus yield, that is 0.1 to the power of n, that is 2 over here. So how we are going to solve this? 100 divided by 1.21, that becomes somewhere around 82.64. Now what does the bond theorem say to us? If I increase the discounting factor, or if I increase the yield rate, the other name of the discounting factor is yield over here. If I increase the yield rate, my bond price has to decrease over there as per the theorem that we have. Now, if I increase the discounting factor from 10% to somewhere around 15%. So how my calculation is going to change? The formula remains the same, only the face value divided by 1 plus yield to the power of n, my face value remains the same, 100 divided by 1 plus yield rate, that is 0.515 to the power of 2, that comes to somewhere around 75.61, which signifies one thing for me, that if I change the yield rate either 0.1 to 0.15, that is 10% to 15%, the effect on my bond price is it has to decrease because my yield percentage has increased. That satisfies the first theorem that we have. The second theorem that we have is, the second theorem that speaks to us is not restricted to only this, which means that if I increase my market interest rates, say for example, if I increase the market interest rates then if the market interest rates is increased, there has to be an effect on the bond price. And how that is going to impact the bond price? It has to decrease. Now the question that comes, how much it should decrease? The decrease should happen, the decrease in the bond price should not be restricted. The decrease in the bond price has to happen exceeding the increase, which means what? Say for example, let us take a problem to understand that if we increase the market interest rates, the bond price has to fall over there, because people might lose interest in investing in the bond markets. They might go to a marketplace and start investing over there. So the moment there is an increase in the market interest rates, my bond price has to fall over there. Now my question is, how much it is going to fall? The fall will happen at a very faster rate. Right? Now let us take a problem to understand how this scenario might arise. Say for example, if I assume the market interest rates like this. Say for example, if I assume that the market interest rates have gone from 2 to 7%, that means there has been an increase by 5%. Right? Now, the moment we increase the market interest rates, what should be the impact on the bond price? The bond price is supposed to fall over there because the investors will lose the interest to invest in the bond markets. And say for example, the bond price originally, when the market interest rates was at 2%, say the bond price was at rupees 200 over there. Now, the moment your market interest rates have increased by 5%, my bond price has to fall over here. Now the question that arises, how much should be the fall in the bond price? The answer is very simple. The fall in the bond price that it should happen should be more than 5%. The decrease will happen by more than 5%. Why is it so? It is because people will lose confidence investing in the bond price because they know investing in the markets will yield them 5% more. That means, say for example, if we assume that the decrease happens at 10%, so what should be the final price of the bond? So the question mark that we had written regarding the price of the bond will say the decrease that has happened is at 10%. So the bond price will come down to 180 rupees, where one thing is clear, the increase in the market rates was at 5% over here. The decrease in the bond price is not restricted only at 5% over here. The decrease has happened beyond 5%. The assumptions that we had made is the decrease was at 10%, which made the bond value to come down at 180 rupees. Now, one thing that is clear over here, it is that the behavior of the investors is very, very volatile over here. Wherever the interest margins are high, people will run behind, people will try to fetch that returns over there, making over here in this scenario where the markets have gone up, the interests have gone up in the market by 5%, the decrease that has happened has been by more than 5%, and over here we have assumed that the decrease was at 10%. I hope in this process the two concepts that we have, that is, the first one, the bond price and the yield moves inversely, and an increase in the market interests reduces the bond value at a higher rate. The decrease has happened at a higher rate. I think both the theorems that we have discussed is clear to all of us. With this, we conclude the session. Thank you.